Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins, and this is recorded on Tuesday, January the 6th. It's been an interesting couple of days, hasn't it? Over 330 points down yesterday and close to 200 points down today so far. This was recorded around 2:30 Eastern Time. So what's going on? Let's look at our three indicators again: treasuries, oil, and gold. The culprit here is the oil price. Treasuries are now 10-year treasuries below 2%. Gold is below 1,200, hasn't changed much. And oil, our other indicator, has basically collapsed. It's below $48 a barrel. Crude oil is basically down about $55 a barrel from its June high of a little over 100. Now, as prices started to come down, especially going into Thanksgiving, the American consumer, rightfully so, saw the benefit of lower oil prices, meaning lower gas prices at the pump. In fact, this particular recording is being done at our home in Sanibel, Florida, and we left from Columbus, Ohio, just on New Year's Eve. And in Columbus, I was able to refill my tank at $1.71 a gallon. I can't remember the last time I saw that price. So as gasoline prices continue to fall, the consumer found they had more money to spend. In fact, as I've said to you before, for every 1 cent decline, the price of crude oil adds $1.4 billion to the economy. I also said that I was concerned about deflation, and in fact, the most recent Consumer Price Index report showed a decline in inflation, including food and energy, at about 3.6%, and that was taking place before we saw the significant continuing decline in the price of crude oil. I would look for the January report to be even more of a decline in inflation. So as the price of gasoline went down at the pump, the American consumer decided they could afford to spend more, not only on Christmas presents, but December was a great month for car sales, and just about anything was sold was in high demand because of the increase in disposable income. To show you the impact of what a decline in gasoline prices means to the economy, the growth rate, the preliminary GDP for the fourth quarter was plus 5%. That is primarily because of the decline in energy prices, with more disposable income and more cash flow in the economy. Again, I would expect as we get further into 2015 and see the final numbers for the last quarter, I would expect to see further declines in consumer prices. So if the last 3 days of 2014 and the first few days of 2015 has seen the biggest decline in the S&P 500 since 2009, why isn't this all positive? First of all, you have to look beyond the gas price at the pump and look at what's happening. We have Saudi Arabia continuing to produce at the rate of 30 million barrels a day. They didn't cut in at Thanksgiving. I do expect them to meet in sometime in January in an emergency session to try and stabilize, because at below $50 a barrel, everybody's getting real nervous. And so if there is a significant decline in demand, meaning slowing economies, then there's no way for the price of crude oil, short of dramatically reducing supply, to rise in price. So I think that what we're seeing now in this particular run in the market, part of it is emotion, part of it is a concern about the global economy, and yet we could be looking at 5 or 6% GDP growth in the United States and begin to move towards a Chinese style of GDP, maybe by the second quarter of this year. So why the sell-off? I think a lot of people have got a lot of money tied up in oil, whether they're drillers or pipelines like we have, or royalty trusts like we have, and they've seen a significant decline in the value of these assets and wonder what's going to happen. The oil patch in West Texas and in the Dakotas is the area that's created the greatest amount of near-term wealth and employment in the United States. If this backs off, then perhaps the economy is going to falter. Clearly, the world markets are saying they want to own the dollar because it's skyrocketing against all major currencies. It's moving 2 to 3% a day against the Russian ruble. The euro is below 120. The British pound is below 153, and so on and so on. So there's a lot of uncertainty what's happening in the global markets. Because of that uncertainty, you have significant volatility. These are not conditions. Let me reiterate, these are not conditions to make sell decisions. You need a little more orderly market and a truer picture of what's happening before you sell. Now, I want to address one issue in closing. Some people have talked to me about should they change their strategy from capital preservation from income. And let me relate to you a conversation I had with a client in early December. This is a client who has income producing assets, you know, all the things that got hit, and yet they still did quite well. They still built wealth in addition to meeting their income requirements in 2014, despite the collapse of oil. The point is, if you're going to have a capital preservation strategy, then you have to stay in a portfolio that is basically U.S. government treasury bills of 1 year duration or less. Now, if you need a portfolio for income and you're going to go from 5 to 6% yield, which is what I'm getting you, to 50 basis points or 1/2 of 1%, where are you going to get the other 5.5% that you're going to need to pay your bills? The only way you're going to get that is by beginning to liquidate principal. That's a disaster waiting to happen, because not only are you selling the assets, you are selling the income stream that the asset can produce. So capital preservation is a great idea, but personal preservation, to be able to pay your bills, to feed yourself and take care of yourself, can be and should be more important than capital preservation. We all know, we've been together for a long time, that markets go up and markets go down. But if you get paid dividends and you have some protection with the use of the S&P shorts, you're going to have decreased volatility and you'll have better performance in the overall market. So if you're thinking about trying to make a switch from income investing to total return or capital preservation, you have to ask yourself, what are you giving up? And what you may be giving up is your ability to sustain yourself only by liquidating your principal, and you'll run out of money. So think about that. As these markets are volatile, you're getting your monthly checks, you're getting the income, prices go up and the prices go down. Don't let emotion judge what you should be doing with your money. Let the money work for you. This too will pass, as it always has. And I expect that we are well positioned to recover substantially when the market turns, as it eventually will. So be in there, be patient. I know it's nervous, I know it's scary, but the reality is you're well positioned, you're getting cash flow, you're not depending upon appreciation in order to survive and pay your bills. Any questions, please feel free to give me a call. Anybody looking for a real money manager, please have them give me a call. This is Dan Perkins, and thanks for watching.